It's been some time since I gave the last update on the grown quality portfolio, so I figured it was time to do so again since I have bought some stocks, and since the last video I have also been continually adding towards others. So overall my portfolio looks quite a bit different. So in this video I will start by explaining the grown quality portfolio, as this portfolio has some logic to the structure, and then I will go through the portfolio, start with the smallest holding and work my way upwards. And finally, I will explain what I'm planning to do in the near future with regards to my holdings. So the grown quality portfolio, what is that exactly? Well, the grown quality portfolio is the portfolio that I created for this YouTube channel basically, and to which I add 125 euros per week. At first, this looked like a very reasonable number and something that could be relatable. But the further I dove into it, the more sense this number actually made. Because you see, I come from the Western Europe, and here the average salary is around 40,000 euros per year. And we know the very well documented 15% rule, which basically allows you to retire either rich or possibly even early. Now, why this number started to make even more sense is that I'm 25 years old. And if we add 125 or 500 in this example dollars to my portfolio, over the coming 40 years with a modest return, that should add up to $1 million. Now this example shows it with a 6% return, and of course I aim to get much higher than. But once again, 125 bucks seemed really reasonable and relatable, and that is what I wanted for this portfolio, to be relatable. I want to do this long term. I really like making videos, and I thought it would be more useful for you as a viewer to see what could happen with a relatable amount. Now, furthermore, my portfolio is divided between smaller caps, mid-sized caps, and the larger stable companies. And these smaller caps are companies around the $10 billion mark. The smallest company is around an $8 billion in market cap, but these companies should have really high EPS. They can do so because they are flipping to profitability, and with the right entry point, these can give very high returns. But they are also very volatile. And that's why we go to more so the mid-sized companies. These are companies around the $15 to $40 billion mark, but they are more stable. They are still very high growth, but they are well into that profitability. These companies should have a more dominant market position or have a clear path towards one. And finally, we have the larger cap stable companies. These companies are very profitable and either have dominant market positions or very large market shares, and ideally not too many competitors. Now, for these smaller and mid-sized companies, I expect them to double in value every 3 to 5 years, because at this rate of compounding, that's over time just goes extremely quickly. So let's start by looking at the first company, and that's Celsius. Now, Celsius is about a 2% holding in my portfolio, so it's not really meaningful. It's also more a watcher position. Celsius has been selling off an incredible amount over the past few months, and I think they are overdoing it. However, I don't think it will be the end of the sell. So I like to settle myself a bit in here and see how the stock is performing and how it's going, and if it's bottoming out, that I will be in a position to buy more of this stock. Now, what else do I like about Celsius? Well, they are growing their market share or sustaining their market share in a really struggling industry right now. The energy drink sector is not doing all too well. We hear that from their last earnings call, but also in the growth rates, because if we look at them, the EPS growth is still very high, but we see revenues increase 23%. Now, this is way lower than a year ago and also way lower than 3 quarters ago. However, the gross margin still increased 320 basis points in the last earnings call, and the net income increased by 55%. Now, the diluted EPS number grew 65%. So with this company trading around a 38 to 40 forward PE, with 65% EPS growth, I think that's not all too crazy. However, we do have some unknowns about the industry growth or the sector growth with the energy drinks. But still, if that manages to stabilize, 65% EPS growth, that should work really well. Now, what else do we have about this position that I really like? Well, if we look at this snippet from the earnings call, where they say Celsius performed exceptionally well on Amazon during July's Prime Day, pushing our share in the energy category on the platform to 22.1% in the last 4-week read ending July 20. And we recaptured our number one position compared to Monster at 21.5% and Red Bull at 13.8%, according to Stackline. Now, Stackline does market data analysis here, so they just come out with these numbers. Another one is Nielsen, which you may hear being referred to with this call. Approximately 12.1% of Celsius' total North America sales to PepsiCo in the quarter was to the food service channel, with strong results in workplace, restaurants, recreation, lodging, and gaming. So the overall market share for Celsius is around a 12 to 14% share of the energy drinks sector. This is below Red Bull and Monster. They are above them. However, Monster is about 3 to 4 times as big of a company as Celsius is. And Celsius is number one on Amazon. Now, these sales on Amazon aren't that big yet, but they are growing rapidly year over year. So then we get to Starbucks. And Starbucks is an incredibly strong brand. I think we all know Starbucks. They are basically on every street corner all around the world. So they have massive store distribution channels. And the reason I bought this stock is because I think it will be difficult to screw up the numbers even more. There were a bunch of activist investors on this name. We know that Elliott is on there. We know that Starboard Value is on there. And what we have heard is that Nelson Peltz was presumably on there as well. However, he sold after the stock jumped 25% due to appointing Brian Niccol, the Chipotle CEO, as the new CEO for this company. Now, what else did I like about this company? Well, it was trading at a 20 forward PE before the jump in share price. And a 24 PE for this company is really cheap. Because if we look at here, we see over the last 5 years, on average, it's traded at a 30.4 forward PE. Now, having a low forward PE is not a reason to buy the stock in and of itself, but it is one of the metrics. And having 2 or 3 activist investors on there, I figured they would be able to extract some value from this stock. Now, what has happened with the jump in share price is they have pulled forward a lot of growth for this business. Now, jumping to around that $90 to $95 range, they did pull a lot of expectations into the stock. They have priced in a lot. However, I do think there is plenty of growth for this stock, going to $110 to $120 in a fair amount of time. And that's why I'm sticking to this position for now. Then we get to my third smallest position, and this is Adobe. Now, I bought Adobe in March or April when everybody thought that OpenAI would, basically eat Adobe's lunch. Everybody seemed to think that Adobe, with their Photoshop product, would get taken out and replaced by some AI features. Well, I didn't think so. And so far, I seem to be right, because I bought the stock around $460 to $470, and right now it's trading at around $560. Now, if we look at the revenue growth, we can see over the last 12 months, or the trailing 12-month revenue, is still growing at about 2.5% quarter over quarter growth pace. So that is still looking very good, and this name will always trade at some higher valuation levels. That's just due to the certainty in this business model. They have that subscription business model, and that's just really loved by Wall Street. Now, what else do I like about this company? Well, they are really playing that AI game. We can see that here from this snip from their latest earnings call, where they say the Acrobat AI Assistant features are now available through add-on subscriptions. In other words, they offer AI products, but they offer it with some extra subscriptions. That means that they are making money from AI. For them, it's not a bottomless pit to dump money into. They're actually making money from it. And what they also said is the Adobe Experience Platform, which we conceived and built from scratch, and which is on track to be the next billion-dollar business, meaning they have their next growth opportunity already standing in line. Because to be honest, I don't expect that much growth going for the Creative Cloud products. But having their next product already in line, their new suite of products, that is very good, but also very important. So then we get to S&P Global, a position that is slightly larger. And S&P Global is basically a play on corporate debt. And why am I so bullish on S&P Global? Well, basically what we are looking at here is the 10-year Treasury yield. And if this has been coming from basically nothing to now 4 or 5%, then explain to me how incentivized companies are to take out debt for investments. Because they are not. And that is also what we saw in the revenues and in the profits. They get more revenues through their analytics platforms, but the biggest margins are on their debt rating. Now, I also used to have Moody. However, I sold this because in the latest earnings call, the stock sold off about 3 or 4%, and I just couldn't figure out why, which indicated to me that I may not know or understand the company as well as I thought, because I was really puzzling through the earnings presentation. And for me, that's an indication that I shouldn't hold the company. I should be able to point towards the metrics that are just not good enough. Now, Moody's has since recovered. However, that doesn't really matter to me. I took a nice profit on it, I think about 20%. So then we get to Shopify. And Shopify, I don't know what this company is having over the last few weeks. Ever since the Japanese carry trade, well, blow up basically, this stock has shot up from about 50 something dollars well into the 70s. I think this stock is now up about 30% in the last 1 or 2 weeks. It's absolutely mind blowing. However, what I like about this company is that they are the number 2 e-commerce platform, well, in North America. And there's only one larger, and that's Amazon. Now, they don't even directly compete with Amazon. They do some different things, and the two can live side by side very easily. Now, what I am most impressed by with this company is how well they manage to grow even at the size they are at. Because if we look at their gross merchandise volumes, we can see that from 2020 to 2021, they grow at 47% and in 2022 by 12%. Now, these slides come from last year's investor presentation. They have one scheduled, I think, in October once again, or it should be around October. This was the time it was last year. But we also saw the subscription solutions grow a lot and the merchant solutions even more. They have a really large amount of different products that they can offer to merchants. And this has caused their product offering to just be so diverse for their clients. It's insane. If we look at their latest earnings call and their latest numbers, we can see the gross merchandise volume increased by 22% to 67 billion. We see the revenues grow to 2 billion, which is 21% growth or 25% growth if we exclude the logistics business, which they divested. And from this, we see merchant solutions, they are at 1.5% and subscription solutions at 560 million. Now, then we get to probably my favorite stock, and this is Duolingo. Now, why do I like Duolingo as much as I do? I will explain in a second. In order to buy this stock, I sold some of my Adobe position. Like I said, I trimmed some of that position already, and I rolled that into Duolingo. Why did I do so? Well, as we can see, recently the stock dipped a bit to around $160. Now, this is where I added to it or bought Duolingo because I think the fair value is around $140 to $150, but it will most certainly always be a bit more expensive. And that is because this company is just growing at such a rapid pace. If we look right here, we can see the monthly active users increasing by 40% year over year, and the daily active users growing by 59% year over year. And Duolingo says that they expect the daily active users to grow at a 50% clip, while for quite some time coming in the future. Then we have the subscription bookings up 47%. We have the revenues up 41%, the gross profit up 41%, the net income over 100%. this company is growing so extremely fast, but they have such a sticky business model because their favorite part about this business, or my favorite part about this business, is their family. Because this is probably the last subscription that will get cancelled, but it is also something they have never really focused on. They made the family plan, introduced it, and basically took their hands off of it. Until recently, when they said, like, hey, this plan is really starting to do something. And we see that people are sticking around on this plan for longer than other plans. So they started putting themes on there in order to increase the monetization, increase the features, and take out some bugs that were in there. Now, then we get to Monday.com, the number four largest position in my portfolio. And I'm up about 22% on this stock in this portfolio. Now, I also hold Monday in my personal portfolio, just like I do with Duolingo. And what I like so much about Monday is that it fits so well into a company's wishes for more efficient communications. You see people missing important messages because, for example, they're on Teams while others are on WhatsApp or an internal platform. Monday can bring all of this together. And that's just extremely important for these businesses. And what they're also aiming for right now is spreading up into the businesses. They are going after the enterprise level customers, and they're quite successful in doing so. So then it's time to look at my top three holdings. So my three largest ones, and the number three is SoFi, or the future of banking, according to some. Now, I don't know if it's the future of banking, but I do really like that neo banking concept there. And I like this so much because it allows them to have less overhead costs. If you look at the traditional banks, they have a lot of stores or offices which they have to pay for. SoFi doesn't have this. So their margins can be somewhat higher or their products can be cheaper. Either way, very good for the expansion of the business. Now, they also have their Galileo platform, their software platform. And in my opinion, that's not something I'm truly the most bullish on. However, I do think this can contribute to nice margins. So that is very positive. And I like the CEO. I like the CEO a lot. Because in this interview he did with CNBC, basically what he said was that companies were expecting 6 to 7 rate cuts in 2024. And what he took from that is that, well, first of all, he didn't expect so. He expected 2 or 3. But if there were 6 or 7, that would mean that the consumer would be in trouble. So what he did was that he really limited their lending products. Because if the consumer was gonna have the issues that it will or that it would need it to have for 6 or 7 rate cuts, then they'd better be safe than sorry. So basically all the growth you saw from the last year was from other products than their lending side. Now, then it's time for Lululemon. And recently I made a video in which I pointed towards 6 items or 6 issues I think this company is having and that they need to address for their coming earnings report. Now, I will link that video up here somewhere, but they have, well, in my opinion, about 6 issues. And one of the most addressable issues, but also one they need to address the most, is their inventory issue. Because they are missing out on small sizes and on color, we see customers of Lululemon going towards competitors. And this is simply something you do not want. They have competitors putting up their stores or placing their stores within half a mile radius of their stores. So having these competitors so close means that if Lululemon doesn't give them what they want, they will go towards others. Now, Lululemon does have quite the dominant market share in the athleisure sector. However, they do need to fix their issues in order to sustain this. However, I'm not going to waste too much time on this company because I want to get towards the part where I will explain what I'm planning to do with my portfolio because I have something really nice here. I really like what I did. But first of all, we have to get to my biggest position. And it may not be a surprise that this is PayPal. I think PayPal represents such a good opportunity in this market. And it's by far the largest holding in my position. I'm really leaning into this one, but in my opinion, this is also justified with the opportunity this stock gives. Now, why do I say so? Well, we see active accounts growing again. They are now at 429 active accounts, and the transactions per active account are also increasing steadily at around an 11% year-over-year growth number. And this is now at 60.9 transactions per quarter. So that is very, very good. And with the help of Fastlane, I think these numbers will go up, and this will become even way, especially this key metric. Because what we are looking at here is the transaction margin, and the transaction margin is now at 45.8%. Now, stabilizing this number is what has caused the stock to go up as much as it has done in the recent weeks, because this is really what Wall Street has been waiting on. And my last video also was around PayPal and why I like them as much as I do, and now even more with the latest Fastlane news. And I will link that video as well up here somewhere. But let's dive into my plans with this portfolio. And this is where I think I have done something really, really nice. First of all, I'm slowing down my buys a bit. And this has two main reasons. First of all, with the rate cuts, I'm not all too sure how much the first rate cut will actually set into effect for the stock market. You see, what I think has been happening is that traders and investors has been itching up to that point where they get the rate cuts and been so on their toes about it that they have just been pushing up the market a bit more. No, we're gonna get them a bit more. And I don't know how much the stock market will actually go up once we get the first rate cut. I don't know how well this will be received by markets, or if this will be treated more so as a buy the rumor, sell the news event. So that is one of my reasons why I'm a bit cautious with my buys right now. But the other one, and that's really easily explained, is that we are in an election. And with the elections coming up in November, this has always been cause for uncertainty in the markets. And markets don't do well on uncertainty. So what I have here is a few charts going back to the year 2000 of how the market has responded towards elections. Now, first of all, we see 2020. A bit of choppiness, but we get out of the pandemic. So still, the market sold off quite a bit on the uncertainty of who is going to become the next president. Then we have 2016, a nice downtrend into the elections. 2012, once again, a nice downtrend. And then we have 2008, and this may be a bit of a mixed picture because, of course, we had the great financial crisis, but we do see a lot of added volatility in the stakes right here. And then we had 2004, also sold off, flattish, sold off a bit. The market wasn't really going anywhere. Then we have 2000. Now, 2000, once again, dot-com bubble. So how reliable this number is, also questionable, but we can see the sell-off going into the election and the bounce back afterwards. So what we have seen over the last 5 election cycle, we have some flattish price action with some added volatility, but we have never seen it go up. And we know election years, we have an overall up year in the markets. That's almost every election cycle. However, going into the election cycle, there's just too much uncertainty. Who's going to get office? Which policies will that take with it? And after that's been said and that's all clear, then we see the markets bounce back. So going into the elections, I will be slowing down my buying, and I'm hoping that either Duolingo goes down, maybe PayPal goes down a bit, so I can add more to those names. Those are my favorite ones. And, well, I'm curious to see as what you will be doing in the future. Let me know in the comments, and if you came this far in this video, you really stuck it out to this point. First of all, I'm impressed because this is a very long video. And secondly, I assume that you've found some value into this. So make sure to subscribe to my channel, because there will be more videos coming next week and thereafter. Now, thank you for watching. and I hope to see you in my next video.